I guess I just had one more slide to go over, so I'll just go ahead and finish this up. So here it says that equipment 40,000, accumulated depreciation of 12,000. So the difference between 40 and 12, so then that would be, what is that? 28,000. So our book value, our assets listed on our balance sheet will be 28,000 for that equipment. Okay. Now, so if we look at that, if we say depreciation expense 4,000 debited, so don't forget that's going straight to your income statement. So then now we're pulling accumulated depreciation equipment. That's going, we're crediting that, and that's that contra asset underneath our equipment. So previously I had talked about that. So how this equipment, well, all we're doing is we're adding it to this accumulated depreciation. So then let's see, summary of adjusting process. These are accrued revenues, accrued expenses, and it shows the effects on them as well. Summary of adjusting process and their unearned revenues, prepaid expenses, and depreciation, how they would look. Adjusting entries, so this is the breakdown of all of the entries we just made. Ledger with adjusting entries, and right there, that's the cash accounts on the left, your account receivable and your account payable and the adjustments that have been made. Ledger with adjusting entries account. These are the prepaid insurance account, the land account, office equipment, accumulated depreciation, account payable, wages payable, and these are a continuation of these accounts. And then these are the supplies, expenses, miscellaneous, and then adjusted trial balance. After the adjusting entries are posted and adjusted trial balance is prepared, so the adjusted trial balance verifies the equality of the total debt and credit balances before the financial statements are prepared. So here's the adjusted trial balance. Okay, notice how you can tell if it's the trial balance is adjusted is you'll start to see accumulated depreciation. You'll also see not fees earned. You'll start to see some of these others accounts starting to pop up. But that's kind of how you can tell if you've went through your adjustments. So vertical decision making, compare items on the financial statement with a total amount of the same statement is referred to as vertical analysis. Okay, so here's vertical analysis, and all you're doing is looking at trends. You're looking at from one year to the next. I mean, when I look at that, I start to question, well, I don't see really anything that sticks out. I can see that our fees earned went up. Let's see what else went up. Our wages increased, our rent increased, our utilities increased, our supplies decreased because it went from 3 to 2,700, and then our miscellaneous expense went up. So then our total expenses, let's see, it did increase. Looks like it increased about maybe 3%, almost 3%. And then our net income also increased about 3% as well. But the thing is, as you do more business, your expenses will start to go up. So keep that in mind, okay? So don't think that I mean, the goal is to increase revenues and minimize expenses. So, but you know, those are decisions where you try to look at it, where you can try to adjust and maybe hold back on some of the supplies and utilities and find ways to save money. Okay, so now that's the end of the slide. I'll post the homework here in just a bit. Okay, thank you for watching, and I hope these videos help.